Hello guys, thank you very much for joining in. This is Ganesh Nayak and I help finance professionals and students to clear difficult exams like CFA and FRM. Okay, and today I'm back with my small video on basically important concept related to FRM level 1. And in this video I'm going to be talking about a very important case study which is generally tested in your FRM level 1 exam, which is Metallgesellschaft, the hedging disaster that happened with that company. So we're going to be having a quick tour on what exactly was the initial position of that company, what happened in that case, and few other details. We'll also be solving one or two questions related to it, okay, just to recap the entire thing, and then we'll also have a quick summary of the case. Okay, so what is the agenda for today's session? We're going to be having a quick snapshot about the Metallgesellschaft company, what was they doing, what was their original responsibility, and what was their thought process when they initiated the trade, okay, and the original position that they had. Okay, so I'll be also talking about those original position, and also to understand what was their hedging strategy. I'll be giving you a brief about the stack and strip roll hedge. Okay, so basically that kind of basic bifurcation of strip and stack roll will be given in this video, and finally what happened in that case, how exactly that company faced loss. Okay, and finally few lessons or few important things that led to the risk of the entire position and led to the bankruptcy of that entire position. They had to close out a lot of position and face a lot of loss. Okay, we'll be also solving few questions and a quick summary on the entire thing. Okay, so let us start with the quick introduction of the company. So basically Metallgesellschaft is basically a German company, and they had a subsidiary in the US market, okay, which was named as UMG. Okay, and they were into selling of oil refined products. Okay, and what they started out doing is they started out entering into a long-term forward contract where they are agreeing to sell oil to their customer. Okay, sell oil to their customer in the physical market. Okay, but those contracts were long-term contracts. Okay, and when we are looking out at that contract, so primarily the customer will buy the product after 3 years, 5 years, 10 years. Okay, on an average the maturity of the contract was basically around 10 years. Okay, now in those contracts the company Metallgesellschaft was basically selling oil to the customer at a fixed price. Okay, and what was their thought process? That if suppose tomorrow the price of the oil, okay, it basically goes up, they face a risk, so they will do an hedging to protect themselves from that risk. So they will enter into a financial derivative. Okay, so basically the company was into selling of oil refined products, and they entered into a long-term contract where they were selling the product to the customers. Okay, and they had a contract that's a physical market contract, and they thought that we might face a risk in this, so we will enter into a financial derivative. So I'll be talking about what was their hedging strategy also. Okay, now before we enter into the hedging part, let us talk about what exactly was the original position. Okay, so they were entering into a physical contract. These were forward contract because the transaction is not going to happen today. It's not a spot transaction, it's a forward transaction. Everything is going to happen after few years, wherein the contract maturity was on an average 5 to 10 years, and the price was slightly fixed higher than the current spot price. So if the current spot price is $100, then the oil price which was set in the contract was 110 or 115, depending upon the maturity of the contract. Okay, and there were also smaller nitty-gritties in the contract, because if the customer feels that they want to exit the contract, okay, then in that case there will be definitely some benefit which they will get. If suppose the oil prices are very high and the customer wants to exit the contract, okay, then the MG company or Metallgesellschaft will pay a certain amount to make sure that they don't face any loss. Okay, so those kind of nitty-gritties were there in the contract. But before we get into the hedging, so this was the original position. Before we get into the hedging part, I'll give you a quick overview of what exactly happens in an hedge. Okay, so suppose if I have an original position where I have taken a short position in the oil. Okay, I'm just giving you a simple example. So in that contract, okay, if suppose I've taken a short position, what is the risk that I face? The risk is that when the price grows up, and the price goes up, I face a huge risk because I've already done shorting. Okay, if the price goes down, I'm in profit. because I have decided to sell at a higher price. Okay, but if I want to protect myself, what I will do is I will enter into a financial market. I will take a long position into the futures contract. Okay, now long position will help me to protect from my loss from the original position. Okay, how exactly? Suppose if the oil price increases to 120, okay, I had taken a shot at 100, so I face a loss of $20 per barrel. Okay, but the long position, okay, which I had taken in the futures contract of the oil, obviously in that contract I'm going to face a $20 profit. So $20 loss and $20 profit should nullify each other. So ideally this is what happens in an hedge. Now the company which we are talking about, Metallgesellschaft, what they did is they had an original position where they were selling oil in the forward market, the long-term forward market. Okay, and simultaneously they entered into the contract, entered into the financial market, and they took a hedge position. Okay, now what exactly they did? They entered into oil futures. They entered into oil futures. Okay, but those future contracts were for short maturity. Okay, so on one hand they had an original position which was basically a short position in a long maturity forward contract, and also to protect it they enter into a long position of the future contract which were for a shorter maturity. Now I hope you guys are clear that forward contract is basically an OTC market contract where nothing happens in between. Everything is going to happen at maturity. The transaction is going to happen at maturity. But if you are in the futures contract, you face daily mark to market. Okay, what is daily mark to market? If you are losing amount in the contract, okay, then you will have to pay the amount. If you're gaining the amount in the contract, you will get the amount, okay, or at the end of the day. That is as simple as that. Okay, so they have entered into the future contract, and they might face the daily mark to market if they started facing loss. Okay, so now this was their hedge position. Okay, but when I'm saying a futures contract, okay, how they could have done strip hedge, they could have done stack and roll hedge. I'm going to be talking about this strategy in detail, and this is the crux or the main part of this entire case. Okay, so what exactly is a strip hedge and what exactly is a stack and roll hedge? Let me give you a scenario. Okay, suppose you have already taken a short position in 70 million barrel, where you are agreeing to sell 70 million barrel of oil to your customer, but you are going to sell every month $10 million for the next 7 months. Okay, now if you want to protect yourself, you will have to take a futures position that is long, the long futures position. But how will you go about? Can you take strip? Can you take stack and roll? So we'll first talk about the strip hedge, but you guys are very clear on the concept that what exactly was the requirement. 70 million barrel, you have taken a short position, you are supposed to deliver it, and every month it's going to be $10 million barrel of oil. Okay, if you had taken a strip hedge, then what you would have done? You would have taken 7 different contracts. Okay, look at the diagram which you see on the screen. 7 different contracts, futures contract. So first contract is for January, which is like 1 month from now. Okay, so first contract which is for January, this is only the lot size of the contract is going to be 10 million barrel. The second contract today itself you're going to make. Okay, so today itself you're going to be making a second contract which is going to be 2 months away. That is Feb. The lot size is $10 million barrel. Okay, similarly today itself you're going to be doing the third contract which is going to be having a maturity of March. Again the lot size is 10. And why am I doing 10? Because ideally I am supposed to deliver to my customer every month 10 million barrel. Okay, 10 million barrel. So I am basically protecting against those 10 million barrels as per the original trade. Okay, now if you enter into this transaction, the only problem that you face is that whatever is a long maturity futures contract that you want to enter, okay, the problem is that if those contracts are not liquid, so you might have to pay a slightly higher amount when you enter into those contracts. So the transaction cost might be very, very heavy. Okay, the second problem in this strip hedge is that if suppose you enter into 7 different contracts right now, okay, and if tomorrow the future price falls down, okay, if future price goes down. So you could have entered into a new contract at a lower price. Okay, but since you have already taken a strip hedge, you have fixed up the long position in the futures contract, because you've already taken a contract for June, July, May on the long term maturity. Okay, so these were the two different problems which were there in the strip hedge. Okay, but the company, which is Metallgesellschaft, they decided to go with stack and roll hedge. So primarily there is no problem with that strategy as such, but what exactly is happening in the strategy? You are stacking the entire lot size. Okay, so suppose you were supposed to deliver 70 million barrel to your customer each month, 10 million barrel. So as per the strategy, you're going to take the first contract, only one contract, okay, of entire 70 million barrel. Okay, entire 70 million barrel. That is called stacking of the lot size and entering into a futures contract. Okay, so I'll give you an example. So when you start, you will have only one contract which has a maturity of 1 month, that is January. And what is the lot size of that contract? 70 million barrel. Okay, the reason you are entering into a near term contract, because the liquidity of that contract is very high. Okay, so when you are entering into that contract, obviously it will be easy for you to exit also, and also the pricing that you get is very, very favorable. Okay, so you entered into that contract. Now as the because see, your requirement is till July. Now you have entered into a contract to protect only till January. Okay, so by the time you reach January, this contract will expire. So what you will do is, by the time you reach January, you will exit from this contract and you will enter into one more contract, but that lot size is going to be 60. The reason I am entering into a new contract with a lower lot size, because in the month of January, I would have delivered to my customer 10 million barrel oil. So I do not face that risk. Now my exposure is only till 60 million barrel. Hence, by the time I reached January, I exited the first contract, and now again I entered into a 1 month contract which is for February month and 60 million barrels. So basically I had stacked entire 70 million and I'm rolling it forward. Okay. Now take a look at this part. If as I reach the Feb end, I will enter into this contract also, and I will again enter into a new contract for 1 month. That is going to be for 50 million barrel. 50 million barrels. So as I move ahead in time, my lot size will keep on reducing. Okay, look at this. As I move again, so it is going to be the continued story. This is called as stack and roll hedge. This entire strategy of stack and roll hedge has to be very, very clear in your mind when you go for the exam. Okay, now stack and I hope everybody is clear. Give me a quick confirmation, guys, on the chat. Are you guys clear on what exactly is a strip hedge and what exactly is a stack and roll hedge? Come on, guys. Perfect. Fairly simple. Now, so this was a position of the company Metallgesellschaft. So they had an original position. They had an original position which is basically a short position in the forward contract, and they had taken a long position in the futures contract. Okay, but the maturity of the contract was short because it was a stack and roll hedge. It was not a strip hedge. Okay, simple. Now what happened? Okay, what happened? So ideally, before I talk about this, what happened in the case, I will give you a brief introduction about backwardation and contango. Okay, so what happens in backwardation? The future price is generally very low. Okay, future price is generally very low as compared to the spot price. Okay, so ideally what will happen is this future price will increase and it will match the spot price. So there's going to be increase in the future price over a period of time. So if there is a backwardation scenario, ideally you should take long position in the futures contract. Simple. The one more example that I have on the screen is of contango, where the future price is very high. So ideally future price would fall to match the spot price. Now in this situation, ideally you should have taken a short position. Okay. Now when Metallgesellschaft enter into the contract, okay, they had this scenario. They had backwardation. So they were very happy, stating that, okay, we had an original position where I have taken a short position, where I had long futures contract and the market is in backwardation. So ideally my future price will increase and I will gain on that long position. This was a scenario that they were anticipating to happen. But what happened is that in the middle of the contract maturity, there was a huge sharp decrease in the oil price. So when the oil price decreased, suppose the oil price was at 100. Suppose the oil price was 100 and the future price was 90 as per the backwardation situation. Then what happened is that as the oil price dropped, you're seeing that the situation which was in backwardation, suddenly it is now into contango, where the future price is higher. Okay, you see that $90 and $75. Now the company is facing a big problem. Okay, because in contango what happens is that your future price will fall because it is higher. Future price will fall to match the spot price. Simple. Now think about it. You have already taken a long position in the futures contract with such a huge volume, 70 million, 55 million barrels, lot size very huge. So when the future price starts falling in, you start facing the loss in the long futures contract, and you will start getting the margin call. You will start getting the margin call, right? You will start getting the margin call. Now what is going to happen? The moment your future price start falling, okay, you have taken a long future position, you are facing a loss, you start facing the margin call, and if suppose you do not have money to pay the margin call, okay, that is a situation of a funding liquidity crisis. So what happened is when Metallgesellschaft realized that they are facing margin call, they were asked to sell their few long futures contracts. They were asked to exit the futures contract. But when they decided to exit, they wanted to sell their futures contract. When they started selling, the price of the futures contract again fell, and the remaining contract where they were long, they started getting more margin call. Okay, so it became a loop for them. The more they were selling, the more price was going down, and the more margin call they were getting on the remaining balance that they had a long position. Okay, so this created a problem of cash, that is funding liquidity crisis. They were not having any money to pay that margin call. Okay, and they faced a huge loss, and they also faced issue with respect to the existence of the contract or existence of the company. Yes, they had taken a huge leverage. Aryan, I'm replying to your query. They had taken a huge leverage in the sense the lot size was very huge. So if the daily trading volume in the oil future contract is, say for example 30-35 million barrel, they had taken 50-55 million barrel on an average. So if they want to exit the contract, they cannot exit because there is no depth in the market. There are no counterparties who will do the transaction. Right? Simple. Right? That is where the company started facing the first issue, funding liquidity crisis. If you do not have money, how will you survive? Okay, and that is the major problem that they face. Okay, what are the other risks which increase their problem? So obviously they were not having cash, but there were other problems which led to their failure. Okay, the first problem is basically your cash there was no cash available with them. Also, one of the very important factor in this case is the German accounting standard. So as per the German accounting standard, on that period of time, if you are entering into a forward contract, okay, and also you are hedging it with futures contract, whatever loss or gain you are bearing in the future contract, you have to immediately book. But for the Metallgesellschaft, it was all loss in the futures contract. They had to show that loss into their balance sheet, into their reports. But whatever gain that they were having in the forward contract, okay, please understand, they had a forward contract where they were selling and the price is going down, so obviously they will be in profit, but that transaction is not going to get completed now. That is going to get completed after 5 years, 10 years. So whatever gain they are having in the forward contract, that is going to come after long period of time. So as per the German accounting standard, the gain that they were having in the forward contract is not supposed to be booked immediately. So what was happening? The company started showing huge amount loss because of the accounting standard requirement, and people in the market, other companies started thinking that this company, instead of hedging, was actually into speculation. So this created a credit risk for them. Okay, so nobody was willing to lend money to this company because they were showing huge losses in their position, in their balance sheets and the annual report. This was the second problem that they faced. The third problem was, like I already talked about, the leverage. Okay, so the leverage was so huge, that if they want to exit the market, it is going to impact the price. If suppose I want to sell short my futures contract of 70 million barrel, obviously when I start selling, the price will go down. So instead of price taker, they became the price maker. Okay, and that created a big problem for them because they could not exit the contract easily. If they had to exit the contract in a smooth manner, they would have to do it in the next 30 days, and which they were not having the money to sustain till that 30 days. If they want to exit immediately, they will have to take a huge loss in their position because the prices will immediately fall. Okay, so these were the three major problems or major reason which led to the failure of the company. Okay, give me a quick confirmation, guys. Are we guys good on the case? Because I'm going to share few questions, 1 or 2 questions with you guys. Give me a quick confirmation. All good? Perfect. Let us come to the question. First question. Start posting your answer in the chat section. Okay, I'll start solving the question now, guys. So as per the question, what they are saying is that the company faced, Metallgesellschaft faced around $1.5 billion loss due to poor dynamic hedging strategy. What triggered the loss? Let us go to the first option. Was the strategy very outdated? No, there was no problem with the strategy. Okay, because we talked about strip hedge also, we talked about the problem in strip hedge also. Okay, so stack and hedge role that they did was sufficient enough for them. Okay, so first is not the answer, first option is not the answer. Let us go to B. Bought too many long futures contract. Again, this is talking about the stack and roll hedge, because as per stack and roll hedge, you have to take a huge quantity or leverage and they have to move. That was not the main reason for the loss. That was not the main reason for the loss. Okay, they failed to predict the significant rise in the oil price. Incorrect. The price fall. So this is again wrong. The last answer is when the oil prices started falling, okay, and they started gaining huge losses, okay, and the subsequent margin call, because the major reason was funding liquidity crisis. If they had money, if they were able to sustain for that period of time, they would have made profit because the forward position was in profit. Okay, so the answer is D. So the answer is D. They had around 55 million barrel. Huge contract, and a daily trading volume was around 15 to 30 million barrel. Okay, so the timing of the cash flow made a problem because futures you had to pay immediately, but the forward contract you will be getting the profit after a long period of time. Let us go to the second question. Kindly post your answers, guys. This is fairly simple. Losses would be realized immediately, yes. So this is a very simple question. What happened? Which strategy was used by Metallgesellschaft? We have read about it. It was not a strip hedge. Okay, it was simply and straightforward stack and roll hedge. Okay, okay. So this was just to clarify that the strip hedge where you are taking 7 or 10, 12 different contracts on the same date of different maturity, that is strip hedge. And a stack and roll hedge, you would basically be undertaking the single contract of near term maturity. So the answer is A. Fairly simple. I'll summarize the entire case for you in a quick 1 minute. So basically there was a company called Metallgesellschaft. They were basically into oil refining products, and they were selling products to the company, to the customer, and they had entered into a short forward contract where they are having a contract with the customer and they will sell the oil products at a fixed price to the customer. Now they were facing the risk that if the oil price increase, how will we hedge? So they entered into the market and they entered into a futures contract. They decided to take a long futures contract, but they had two options. They can enter into a strip hedge, or they could have entered into a stack and roll hedge. Strip hedge, like I said, it's going to be 7 or 10 different contracts on the same date for different maturity, okay, and different lot sizes. But when we talk about stack and roll hedge, single contract, near term contract of a huge amount, okay, of the huge lot size. They decided to take a stack and roll hedge. When they entered into the contract, the market was in backwardation. That means the future price was lower, spot price was higher, and they were expecting the future price to go up, and they would make profit in the futures contract. But when the oil price dropped suddenly, okay, at that point in time, they started realizing that the market has now moved into contango, and because of which the future price is higher, the spot price is lower, and the oil future prices started moving down, and they started facing loss. And because of the huge leverage that they had, the huge lot size they had, and they started facing huge margin calls in the contract, and they had no money, or they were facing funding liquidity crisis, and which led to further existential issue. That was the main problem. There were other issues also, German accounting standard and the huge leverage. Okay, so this was the entire case study that we covered. This is one of the important case study which can come in your FRM level 1 exam. So please make sure that you are well versed with what is happening in the contract. Obviously, I have not gone into the entire detail of the case because I wanted to make sure the core part, which is stack and roll hedge, is clear to you, because you can expect some questions related to that topic. Okay, so for those students who are not aware about our institute, basically we at Fintelligents, we basically train students for CFA and FRM and other finance related courses. We conduct live online classes for both CFA and FRM, okay, wherein we give the around 100 to 120 hours of live session. We give question bank, notes, right, sectional tests, mock papers, plus there are also video lecture packages which is generally at a subsidized rate for students to appear on their own. They want to prepare on their own. We also give question bank series for the students to prepare for their exam. Okay, in case if you are preparing for the November exam and you are looking out for any free material like how to prepare for the exam, or some free material for the exam, then you can WhatsApp on this number. We'll help you to guide you on the same. Okay, and further, in case of any queries, I'm there for the next few minutes. Guys, I'll be coming up with more such session in the futures. I'm planning to do a lot of YouTube lives on simple topic related to the exam. Do join me for such sessions. Okay. And in case you have any further queries also related to the exam, related to the concept, I'll try my best to revert back to you as soon as possible. You can reach out to me on this number. Kindly WhatsApp on this number. Okay. And then if possible, I'll definitely give you a call back. I hope everybody is clear on the concept, right? It was great to have you on the session today. Thank you very much, guys. Thank you very much for joining in. We'll be having one more session tomorrow and day after tomorrow. Thank you, guys.